So financial markets have indeed seen the growth of sustainable finance. But although great progress has been made, there still is a way to go to bring it to the mainstream. We have a fantastic panel here representing the different stakeholders involved. We have an issuer, buy-side, lenders to central banker. Each of them will give their perspective on how sustainable finance influences investment strategies, securities lending, collateral management. The panel will be moderated by Sean Kidney from the Climate Bonds Initiative. And he'll be accompanied by Xavier Bouthors from NN Investment Partners, Flora Chao from the International Finance Corporation, Andy Dyson from ISLA, and Florence Fontan from BNP Paribas Securities Services. And Odonnat from Banque de France, sorry. Ladies and gentlemen, over to you.
Thank you. Thank you for joining us in this panel. This is about sustainable finance from small to mainstream. I'm Sean Kidney. I'm the CEO of the Climate Bonds Initiative. We're a global NGO working to grow green bonds, green finance, and channel capital into climate solutions. Before I introduce my esteemed and fantastic panelists, let me just give you a couple of words of context. We're partly here because green bonds have been an amazing growth story over the last few years. They're currently, apparently, the fastest growing asset class on the planet, if you want to call them an asset class. We're likely to see up to 250 billion US of issuance this year. We'll hit about $1 trillion outstanding early next year. We've already seen $1 trillion outstanding of the green with social, with sustainable, the sort of pool bond, according to Bloomberg. Of course, global bond markets are 100 trillion, so it's still a very small percentage. Green bonds have been developed as a kind of response to climate change, a particular interest. The context in here is the reports, in particular the last couple of years. The International Panel of Climate Change put out a report on 1.5-degree Paris Agreement targets last year, which was chilling in its reading. It essentially says to have even a reasonable chance of creating a future which is not runaway climate change, we've got to halve emissions in 10 years. That is a humongous job, given they grew 3% last year, and in the last 30 years, we've put in more emissions into the atmosphere than the previous 150 years. So challenging. I won't go into the consequences, but I'd also refer you to the International Energy Agency's 1.5 and 1.8 degree modelling, released in headline form in November, and they put out another release a couple of days ago, which essentially says no new fossil fuels can be built if we're to achieve those Paris Agreement targets. Okay, difficult things. The solution to all of this is essentially vast capex, cast investment in climate solutions, clean energy, but also low carbon transport, rail as well as electric vehicles, water solutions, energy efficiency in water, sustainable water, and above all, green buildings, energy efficient buildings. About 40% of that reduction in emissions in the next 10 years has to come from emissions reductions in the built environment. It's about $90 trillion of capex being estimated between now and 2050 to achieve the transition, so a fairly large slice. We clearly, in theory, have the capital, in the sense that we're awash of capital, especially awash with capital in zero or negative rate instruments, as our previous speaker outlined. You know, we have a lot of underutilized capital on the planet. I mean, this poor man's pension is not going to be paid by investing in German bunds. He needs a little bit of yield. So in theory, we have this opportunity to be able to shift capital to zero and negative rate instruments into yield instruments if those investment opportunities are there and can be created adequately and in time. So green bonds become the evidence that if you do create green investments, people will invest. There have been some very interesting developments in the last couple of years. China has taken to this like a duck to water. And now we have every regulator, from the banking to the central bank to the industry regulator, with green finance initiatives and so on. It's now the world's second largest green bond market. We've seen the network for greening the financial system an association of what I was told is 51 or 52 central banks that, as of today, changes every day, working on issues relating to greening the financial system with Banque de France, and we're privileged to have Yvan here, one of the leading members and the secretariat for that. And we've also seen movements in Europe to standardise some of the underlying infrastructure as part of the EU action plan, notably the taxonomy. I've been a member of the high-level expert group of sustainable finance, and more recently the TEG developing an EU taxonomy. We will come out with a finalised version at the beginning of next year. That will be regulation in Europe by the end of the first half of next year, and that will be most importantly driving investor disclosure under the TCFD implementation in Europe. So investors will be disclosing not only their high carbon assets, but also their sustainable assets, and they'll be using the taxonomy as guidance, and that will then cascade down to their requirements of corporates and banks and so on. And of course, the European Banking Authority is also planning to use the taxonomy as guidance. So we have the beginnings of standardisation. Just one last point. People often say, what about all of these standards around the world? Are they very different? Actually, they have different names, but they're all from the same source. The green bond principles, with a bit of taxonomy work, my climate bonds and others, are the parents of all of these things. So we actually already have a fair amount of uniformity. And the IFC, and Flora, Chao is here from the IFC, have been working through the Sustainable Banking Network to ensure that is the case. So it's not that different, but there is a difference between China and Europe going forward. That's the context. Fast-growing market, lots of opportunity, but still small. $1 trillion outstanding. So the question is, how do we make this vast so we can actually adequately address the challenge of our times, which is to shift our economy to a green footing, a clean green economy, quickly, rapidly, in time to meet the Paris Agreement. Not so much deadlines, but requirements. Remember that effectively, those scientists have given us a doctor's diagnosis of cancer. Unless we address this cancer, we don't have much of a future. And we've got 10 years to address it. On that point, can I now introduce to you this fantastic panel? First, Yvan Odonnat is the Deputy General Director of Financial Stability and Operations at the Banque de France, and he'll kick us off. But then we will go, and I'll just do the introductions first, if I may. Xavier Bouthors, Senior Portfolio Manager, Treasury Fixed Income Solutions for NN Investment Partners in the Netherlands, and a leading green bond investor, by the way. We have Flora Chao from the Global Head of Funding. I love being a global head. I love that title. For the IFC, who have been one of the drivers of the green bond market. They did the first benchmark-sized bonds in 2013, which kind of cracked open the market. We also have with us Florence Fontan from the Head of Asset Owners at BNP Paribas Securities Services, and then we'll finish up in our lineup of initial comments from Andrew Dyson, who's from the International Securities Lending Association and a market maker in the area. So, Yvan, kick us off. Small to mainstream.
Of course, we talk a lot about financing the transition in this panel, and indeed the network that you mentioned, the NGFS, was created to join our efforts. Central bankers, supervisors in the area of financing, that is helping to align the incentives so that we get the adequate amount of financing for the transition. What I mean by that, it's not only public financing, but it's also private financing. It's a joint effort. But the network was also created to help in the area of risk management. And this is on what I will focus my comments. There are two aspects. The first aspect is the risk to which individual financial institutions are exposed to. You know them, physical risk, that is the cost of extreme weather events, not only for insurances, obviously, but also for banks. Transition risk, meaning that when you put in place measures to help in the transition, actually you may decrease the value of a number of sectors of the economy, and that could be translated in losses for the financial institutions. So financial institutions need to be aware of that. And our sense is that actually they are not so much aware of that. And besides, they don't necessarily know how to measure that. So the purpose of the network is to help into this direction, help in the measurement, help in the management. In the management, regarding the measurement, that is the exposures to climate risk. Of course, there is work on the taxonomy, the work on the disclosures, and that this is going beyond the remit of central banks of supervisors. But we are concerned, and what we do is that we monitor. We ask banks or insurances to provide us with their own figures, and from that we can help them in improving their methodologies. And that's called broader for the management of these risks. And consistently with this purpose, the HGFS is acting very concretely. We started the work 1 year ago, and I think by mid-2020, we will be able to publish a guide to help the financial sector to better manage the climate-related risks. And it's a guide for the institutions themselves, but it's also a guide for the supervisors to do this work in a consistent way across the globe. The network is 51 members today, covering the 5 continents. Okay? But the risk is also that the second dimension about the macro view. There is a macro dimension to the risk, which is the fact that it's not only a risk for individual institutions, it's a risk for the entire economy. And you need to have scenarios that helps you translate the risk, climate risk assessed by the IPCC panel, for instance, the climate scientists, into a risk for the economy. And that's the building of scenarios for the transition to help you assess the impact of the transition on the financial situation of individual banks. This is also a huge avenue of work, and to be concrete, also I think by the same deadline, that is mid-2020, the network will publish sort of voluntary guidelines to help the supervisors of central banks to beat this type of scenarios.
Yeah, this is critical, right? Because
yes.
Frank Ellison, the chair of the network, has been saying that central banks can no longer look at history to determine the right regulation of the future. The scenario planning is an absolutely central bit of work that's required now to work out the right kind of regulation.
We're talking about mainstreaming the financing. What we want is to mainstream the management of climate risk. Today, we are able to run a stress test on credit risk to which financial institutions are exposed. This is done at, for instance, in Europe at a euro area-wide dimension under the leadership of the European Banking Association.
So can I ask you a question? Sorry to jump in, but if we look back in history, most regulation comes in as a reflect of that something happened in the past. So generally, something bad happens, regulation appears, right? I think how confident are you that you can overturn that general premise? Because you're looking at scenarios, you're looking at what might happen to manage that risk. How confident are you can be more successful than perhaps we've seen in the past with more traditional regulatory approaches? Does that make sense?
This is tremendous difficult. How confident I am, I'm telling you that we are trying. And it's already, I think it would be a great achievement if we managed to agree on these scenarios. That's the purpose of these guidelines that will be published next year. But once you have that, you can do the following. You can run stress tests. You can stress test the financial sector. And you can do it at a national scale, you can do it at a broader scale. And of course, this is a work in progress. You get results and you will improve the process. That's the way it works. That's the dynamic.
But you've also been looking at the investment side of the portfolios that are managed at central banks. You published a paper recently. Tell us where you got to in the Banque de France with this.
Well, the idea is the following. We want to be consistent and to lead by example and to implement SRI's strategies for our portfolios. The difficulty here is the following, is that the central banks, they have mandates. They're in charge of monetary policy and financial stability. So this is putting constraints on what you can do. We cannot be as transparent as I would like for the management of our portfolios. We care about liquidity. So we have this type of constraints. But that said, what we have decided, for instance, at Banque de France, and a number of other central banks are doing the same, is to try to green part of our portfolios. We chose to do it on the portfolios that are back to own funds and to pension liabilities, because these are the portfolios that are under our full responsibilities. As far as Banque de France is concerned, it means approximately 20 billion euros. And what we do is rather simple, is that we have part of the strategic allocation which is dedicated to the purchase of green bonds and investing in green infrastructure funds. That's what we do.
Okay, fantastic. So I'm now going to go to a fund manager who has had a lot of experience in investing in green bonds and in green infrastructure. Xavier, from NN's perspective, you raised a few things in our initial calls about what you're doing, but you also talked about a kind of agenda for going forward, about collateral frameworks, counterparty frameworks, and so on. Tell us a little bit about your thinking as one of the leaders in the sector.
Yes. So as an asset manager, so we've been quite active into the ESG and sustainable aspect of finance. So I think you can say, like, on our side, we see it as mainstream. And that means, like, if you have a strategy, like an equity or fixed income strategy that is labeled as sustainable or ESG, so impact investing, green bond, etc., and these portfolio participate in efficient portfolio management techniques such as sec lending, that means that these activities also have to integrate the sustainable aspect of the portfolio. And next to that, we also see clients' demand, so like institutional investors that invest in our funds or give us mandate to manage. They also have like some requirements to comply and be ESG. So that means that on our side, we have to scratch our head and think, okay, how are we going to make these activities indeed sustainable and ESG proof? So I would say, like, each company may have like their own views and their own policy on that topic, so how to integrate and what aspect they should be looking at. So for example, like, it's something that also has been mentioned yesterday, the collateral aspect. So if you have certain exclusion in your portfolio, like for example tobacco, weapons, then you don't want to accept them as collateral, because if your counterparty default, then they become your assets on the balance sheet, so you don't have any conflicts about that. From equity versus fixed income, also you have different categories to take into account. So when you invest in an equity, you need also to be an engaged investor. So engaged investors mean you need to also participate in voting. So that means that you want to be able to get your stock back in time to be able to come and use your voting rights. So there's a lot of aspects to take into account, and one of them is also make our clients and our participants comfortable about the activity and see that indeed you can manage a sustainable ESG activity strategy, and you can still participate in such activities like securities lending or repo. It's also like, to go back to a little bit what you were saying, it's on the liquidity side. We see also as important as asset owner to bring the assets to the market, to have like the sufficient liquidity either for collateral purpose, like when you talk about like bonds like HQLA bonds or corporate bonds. So we need to be able to bring that liquidity to the market because it's also beneficial from price discovery. So there's all these aspects that we have to take into account. So after all of that, then we can clearly say like it's been mainstream on our side.
So it's mainstream for you.
Yes.
And in terms of growing the rest of the market and bringing everyone else to follow you, have you got any thoughts, given the journey you've been on here?
Oh yeah, it's not an easy one. Because you talk to a lot of different participants. So, and again, they have like their own view or their own policy on this ESG and the sustainability. So you need to be able to address and be able to have a common ground for everybody we have to reach. Will everybody follow? Hopefully, people will be convinced with what I'm saying. So let's see.
Okay, thank you very much. And now I'd like to turn to Florence, because you've done this survey, 300 asset managers around the world. Can you tell us a little bit more?
Yeah, so I'm sorry for my voice. I'm starting to losing this morning, but no. So to start with the first headlines is that yes, from a buy side, from what we see on our survey, ESG criteria are mainstreams. Okay, so there's no doubt about that. So we've done. I mean, we've run the second time. So after 2 years, we've run the second edition of our ESG survey, which is covering 350 asset managers and asset owners across the world. And they are entities from 1 billion to 25, 30 billion of assets under management. Okay, just to give you an idea. So it's quite a meaningful sample. In what we see, I think 75% of the respondents confirmed that 25% or more of their portfolio have taken ESG criteria in the investment. And that, if I compare with the previous edition, so 2 years ago, it has increased by 75%.
Wow.
No, by 27%, sorry. 27%.
Still good.
But it's still significant. So we see a strong acceleration over, quite small time. In what also was striking, it is no longer a question of brand, a question of positioning, a question of marketing, but it's the true conviction that ESG criteria investing will lead to sustainable performance, especially in the, I would say, low interest rate environment. So it's looking for yield in general, but also long-term yield, and in particular for those asset owners. And most of the asset managers that were part of the survey have a strong part of institutional investors as clients. So it's not only retail asset managers. What we see also compared to the previous edition is that we see also a better maturity, an increased maturity on how to deal with the environmental aspects. Okay, so the E of the ESG. The S is still a struggle for most of them, despite a strong pressure of integrating social aspects into the criteria. So the pensioners, the man in the street, man and woman in the street, and I think I've saw in the previous speakers, it says that inequality and social aspects is raising to populism, etc. So there is a strong pressure from the street for those institutional investors, and notably including state-owned official institutions or pension funds, to take into account social aspects. But that is still extremely difficult for those institutions to take that value quality. In general, I think the first barrier, how to make it bigger, how to make it mainstream for everything, the first struggle or the first barrier that is highlighted is data. 2 years ago, it was the absence of data. I would say here we still have the absence of data on some aspects, social notably, but the main new topic or new barriers is consistency of data across notably environmental aspects, because here, thanks to, in France, we have the Article 173 that impose some disclosures, etc., and there's a lot of voluntary disclosures on the issuer sides as well. So data on climate is much more available than 2 or 3 years ago, but the consistency is not there. We've done an experiment ourselves that we've run the exact same portfolio with using different service providers of data with E, S, and G ratings, okay? And the result of how much you're impacted, or the absolute rating on those ESG criteria for the same portfolio were quite diverse, depending on which data flows you take into account. So the volatility of those ratings is a problem for the institutional investors. And I think more standardization, more quality, more clarity on what is the standards, the taxonomy, etc., will help in improving the quality and the consistency of data across the world. To come back on just maybe what Xavier was mentioning, and also for this audience, most of the institutional investors are taking ESG criteria in their investment decision. However, it's not ESG or is not full part of their entire process in-house. It's still difficult. So generally they have a policy, I mean, at the minimum, an exclusion policy, some having more forward-looking ambitions in their investment strategy, but to have that in every single processes is not yet there. This is still a journey to come. And by being more comfortable, or you see some cautiousness. So typically on collateral management, on securities lending, for example, you have a tendency to refrain from going into that because they don't know exactly how to deal with those processes and make it consistent with their ESG policy as of today. So you see, I mean, NNIP is, as Xavier explained, is one example that they have managed to take that into account, but the journey is still there. And we have seen asset owners stopping from securities lending activity because of ESG criteria.
Wow, okay. Can I pick you up on the data question, ask a question about the data? With the EU taxonomy work, which is obviously an attempt to standardise the reporting framework amongst other things, the regulation is initially going to be targeted at the investor community. Now, there's a debate going on at a member state level about the implementation period required because of the lack of data sources. That is, will it take 6 months or 18 months for banks and corporates to be able to start feeding data back up to investors they can disclose? Do you want to wade into this? What's your view about how long it'll take the industry to catch up once a clear set of rules is published?
So, today, we are, I mean, as custodians, we're helping already our clients by analyzing our ESG criteria on a portfolio, okay? So we already have different sources, and it's actually a solution where we combine multiple sources because, as I said, we don't have one providers that we're comfortable with. They're more specialists on some areas, etc. So, but it's true that the taxonomy will change some of the information, the way it is provided. So generally, it's not financial institutions themselves that are, I would say, at the source of the data. So we rely on providers of data that, and here on those ESG criteria, you have, I would say, the traditional rating agency or data providers, but you also have hundreds of fintechs that have developed specific using satellites, images, I mean, numbers of elements with algorithms that are providing those data. So I think there will be some time before we can really rely on the data quality. It doesn't mean that we cannot provide some aspects of that, okay? Because I'm convinced that maybe, I mean, it depends on what the consequences are, okay? In particular, I mean, does it mean that you need more capital, more things? And that creates volatility. But if it's just disclosure, why not using, even if it's not ideal data, but it's starting point, because at least you get the ball rolling. But it really depends on what's the stick behind it, okay? And that is only the regulation will tell us. So I think to have, and depending on the scope, I would say 6 months, because here you're talking industrial processes, and we know how sometimes it's difficult in all institutions to have the IT integrating those new sources of data, etc. So 6 months may be a bit too short. 18 months, I think we can do better.
Okay, that was a question specifically for the German government, who's worried at a member state level about this issue. Thank you for that. I don't want to turn to emerging markets now. Flora, mainstreaming this in emerging markets, not huge capital markets anyway, but this is, of course, your field of endeavour. Is this going to happen? How do we do it? What are the issues? Or is actually Xavier right, then it's creeping up on us as mainstreaming?
Yeah, I'd like to think that it is in the process of being mainstreamed as we speak, very much so at IFC, because our core mission is to have development in emerging market countries, and climate change and addressing climate change is a big part of that. So in terms of mainstreaming, I would like to think that IFC is very much at the forefront of mainstreaming in terms of addressing climate change. But emerging markets, it's a hard one. If you look at who is being affected by climate change, one of our studies showed that 100 million people will actually go into poverty because of climate change issues. And ultimately, most of these people live in emerging market countries. So it is something that emerging market countries should be thinking about if they're not. And we were talking earlier with Yvonne that one of my goals as the global head of funding, and I also oversee investor relations, is trying to encourage our central banks who invest in our bonds, but trying to encourage them to either participate in NGFS or to buy our green bonds and our peers' green bonds. So in addition, we do quite a bit of investments in emerging markets with respect to climate. We really try to bring in private sector investors. So a couple funds that you may have heard about are the Mundi Planet Emerging Green One Fund, which was a fund that we partnered with Mundi on, that's focused on buying green bonds by issuers from emerging market financial institutions. Earlier this year, we launched another fund, this time with HSBC Asset Management, where the green bonds that the fund purchases would be by issuers in emerging markets focused on the real sector. So this is the Regio Fund, the Real Sector Green, or Real Economy Green Investment Opportunity Fund. So trying to encourage, whether it's manufacturing, agribusiness, infrastructure, health and education, so it touches upon both the environment, but as well as the social aspects of this. We're really looking to try to encourage these issuers in emerging markets to access the capital markets.
Okay, so does that mean you're hopeful of the reception? I know you've been working hard at it, but I'm curious about the nature of reception. Talk about China, but in other countries. Do you feel this is getting traction?
Yeah, so the reception on, you're saying on both the issuer and the investor side? In general, yes, absolutely. I think the reception is positive, but so the previous speaker spoke about New Delhi. I remember visiting some investors, and these were more asset managers in India, and this was a couple years back. And I was talking about ESG, and the response was, you know, in India, we have basically, you know, as an emerging market country or developing country, we have more kind of urgent issues to address. But fast forward to today, I think with, you know, with the heat index and whatnot in India and the flooding, these are urgent issues. And my guess is if I were to, and actually I did meet with RBI recently at a conference, and we talked about ESG, that I think these are being looked at now that maybe even 2 years ago they might not have been focused on.
Thank you. Andrew, markets. This is a conference really about markets, and you've got some thoughts on markets.
Thank you. Good afternoon, everybody. It's interesting, when you're last on a session like this, you worry that there's nothing to say, but also there have been some great points made earlier. I think that when you look at our corner of the markets and you look at ESG and sustainable finance more broadly, there's a couple of things which are quite obvious sort of technical issues that we have to deal with. The first one is that when you lend a green or sustainable fund, particularly against non-cash collateral, there are some challenges around the collateral that comes back. And as Xavier said earlier, if you are the recipient of that collateral, then you suddenly find yourself the owner of it because of a default. If that collateral turns into your actual portfolio, even momentarily, that could breach the fund's guidelines. So there is some work to be done there. And part of that work is around this issue of standardization and taxonomy, because you're absolutely quite right that when we talk to our market participants, the definitions that they're dealing with are almost as many as there are firms in the market. And one of the things I think that we see is securities financing, together with much other financial markets, is a rules-based standard system. So we have a bunch of rules. You do this, you can't do that, and if you do that, you're going to get punished. And that's very clear. What we've got, though, is now we're crashing into a values-based world. A lot of this discussion is about values, and therefore it's quite hard for, if you like, a traditional rules-based structure to work out how it interacts with a values-based environment such as this. So therefore, it's important that that taxonomy comes through, that gives us some of those hooks around which we can build products and build out opportunities for our clients. The other thing I'd say that's important here is that once you've got that level of taxonomy and standardization, some of the issues that you allude to about funds, ESG funds, almost automatically assuming that they can't deploy lending, begin to fall away, because a lot of that is around education, understanding the role of lending. And here I'd just make a slightly broader point, which is one of the things that we do is we try and ensure that markets are deep, liquid and available for investors, both to move in and out of those investments. That's sort of what we do as a function. If you don't see that similar level of liquidity coming through for ESG wrapped funds, then inherently they'll be less liquid, more expensive, and potentially less attractive to retail investors. And one of the things that I've seen here, certainly I've been in Brussels all week talking to officials at the Commission, is we know there's a big agenda around developing the so-called Capital Markets Union here in Europe. And there is an ESG element to that, because it's all about creating that competitive environment, allowing Europe to be truly competitive against other global powerhouse economies, principally in North America. We are leading the ESG debate here in Europe, and we need to make sure that we don't lose that opportunity. So it's all about creating that level of liquidity, that level of competition, and also making Europe a little bit more self-sufficient when it's looking at how it funds and organizes itself around generating returns for shareholders. So I think that the final thing I'd say is that, to your point about ESG and lending, and Xavier and I were talking about this, I think that there is more that can be done by stakeholder groups and people like ourselves to start setting some of those benchmarks or principles. A good example of that in our market is we did some work a couple of years ago with the Bank of England in the UK, and we helped create the UK Money Markets Code, which is a code of best practice. And I think that where we're going to see a lot of activity from regulators, and certainly we want to be part of that, is the creation of those codes. So I think there's a great opportunity here. We shouldn't necessarily assume that ESG funds present any different issues to we see with standard securities lending opportunities. Just have to look at it in a different way.
Very good point. Okay, so there's a lot more we can actually do to make this, to grow this. And you're going to be doing a lot of it in your association.
Yes.
Questions from the audience. We've got an opportunity now to get some feedback. We might have some questions coming through the app. In the meantime, because I don't see it on my screen here, I'm going to ask for your help. Can I get a 3-minute interim with you talking to the people next to you about questions arising? This is interactive, folks. This is to get your blood going before we have lunch. I want you to talk about implications from this session, and then I want a few people to stand up and give us a question or a comment. 3 minutes. I'm going to start timing now. You must talk to someone next to you. If not, I will come around and shift you around. And you, sir, you have to talk to that person there. Please. Okay, 3 minutes. This is unusual for an end of conference activity. Just get the energy going. Make sure you find someone to talk to, please. Otherwise, I've got to come and grab you.
So if I talk up, I don't know if the mic's off. I'll talk to you after. Yeah, I'll talk.
Switch off.
You absolutely.
I just want to say, I think a big part
I know you're a speaker, but you've got to talk to someone. Come on behind you.
Why is the Dutch government so influential in getting investors on board? So we can get
Allez, parlez s'il vous plaît.
So should we have a question ourselves?
Interesting.
So Sean, should we do it
Very good.
ourselves?
Very well.
Should we do it ourselves?
Excellent. Sean.
So I have a question for you, which is, this is semi-personal. I worry that a lot of the so-called green bond activity and investment activity we hear about firms issuing, it's almost as if it's a bit of a badge of honour. So I've done my bit, I've issued a green bond, that's it now, move on. And so how do you link that with the upswell from the ground up, which is the people on the street, climate change protesters? How do you link those two? Because to me it seems a bit disconnected at times. So how do you connect the groundswell of opinion coming from the street with the institutional activity? Because I think governments could do more to change behaviour.
Here's your comment. I'll call you to say something if I have a gap.
What I was saying, so it has to communicate from the
Feel
government.
free to dive in or something too, if I don't get much.
Sure.
coming from the,
Okay, folks. Thank you for indulging me. I appreciate it. We have a couple of microphones in the room. The people with the microphones will be running to you, because the thing about climate change is we need speed, speed, speed. I'm going to give you 30 seconds. I'm hoping a few people will volunteer. 30 seconds to give you a comment or feedback. Any hands up in the audience, please? I'm hello, huh?
John, come on.
We'll pick people.
One in the front here. Microphone coming your way.
So we started off our discussion with my question to my colleagues here, that despite overwhelming evidence and data that we are in fact warming the planet, there are still naysayers in every society that say no, we're not, and those people are very difficult to get to. So how do we actually get to them? Because it all starts with change in human behavior. And as was pointed out here, it starts with big data. The more data you have, the more you present it in a way that is more convincing, is probably the way we get through to those people. The second point that was made is that it starts with individuals making an effort to think about ESG in a way that, what are they actually going to do? And we went through a couple of examples. And the example that I use personally is that I used to always go through, when I'm booking a flight, I always never tick that carbon box, because why should I pay for it? I changed that behavior a few months ago.
Fantastic. Great point. I will just say one thing on the individual action, because I think it's really important from a moral position for everyone who's concerned about the future to be looking for things to do. But the key things we have to do are systemic. They're about shifting to clean energy. They're about changing building codes so our buildings are much more efficient, and so on. So bear that in mind in your thinking, that whilst we need to take action for moral purpose, the real change is how we work together and change our system, and of course, mobilize finance to shift, which is your job. So the work you can do to make sure that finance is mobilized to the right kinds of solutions is the critical work of the decade, the 1 decade left that we have before we run out of time. Other comments or questions, please?
Sean, if I may.
Go ahead.
Sean, if I may, I will slightly contradict you.
Go on.
I think I agree with you that we have, as finance members, we have this decade, the mandate that you just gave it. But we also, as individuals, need to change those behaviors. How many in this room have done its own carbon footprint as individual? Okay, you can find on internet plenty of those. Okay, I'm sure even if we are, on those topics, I'm not sure everyone has done that. So I think those individual awareness will help as well with your kids, with your family, with your friends, will facilitate our job as bankers, as individuals. So I would not diminish the impact of the individual behaviors change, because that is also how you influence on your day-to-day job.
So Sean, I think that there's another factor which I'll just throw in there. This might be my view, not ISLA's view, just to be clear on that one. Recently in the UK, the Royal Shakespeare Company decided to sever its sponsorship relationship with BP because BP is a big bad oil company and they don't want to be associated with them, allegedly. The reaction to that was quite interesting because many people in the UK felt that that was just the Royal Shakespeare Company getting a badge of honour. I've done something, I've got rid of BP, how good are we? I'm not sure that works. I think you should be working with these larger companies to understand what they're doing, what they're not doing, and I'm not here to speak on behalf of BP or the Royal Shakespeare Company, but I do worry that some of these sort of climate things are a bit like a badge of honour. I've done my thing, and therefore we walk out feeling very pleased with ourselves when we're not actually making a change.
But to come back, we see in the asset managers and asset owner space, we see two attitudes. One which is the exclusions, I only work, and one which is I accompany the transition. I accompany to help move to a best behaviors, etc. And both helped.
And Bram, how have you managed this balance between divestment and engagement, which I think is being raised by Andrew at NN?
Yeah, we do both. So the thing is like, if you look at our strategy, so the vast majority of our portfolio are integrated ESG parameters in their investment decision. And there's a strong first exclusion. So we have a list that is on our website that you can follow. And also we have like a strict criteria in terms of engaging with companies we invest in, supporting them. So to also like help them to transition to where they should go. So this is compatible, yeah.
But Xavier, I think that's listen, my perspective, that's just another manifestation of the general feeling that is coming certainly from certain quarters in Brussels, that fund managers have too much power in companies, this idea of shareholders' rights and the fact that, 5 or 6 large investment firms globally tend to own most companies, right? So therefore, that's just a subset of that same issue about the control of companies coming from institutional investors. This is just one of those factors, which I think is a huge agenda that's going to play out over the coming months and years here.
Anyone want to say something they didn't get a chance to say before I wrap up? Thank you.
Ok, vas-y. Musique.
Sorry, did I?
It's okay, no? It's okay. Thank you.
Merci. We need to go towards the last, we need to finish up. I'm going to say our main job here, apart from understanding our role as citizens in a broader society, is to now think about the role of this industry and how this industry contributes towards the transition. We have a vast capex challenge. There is no doubt that the bulk of what we have to do is not to eat less meat, that is one thing that helps, but it is about to change the food industry. It is about to change our industry. It's about greening our cities. Something like 80% of people will be living in cities in 2050, and those cities need to be clean and green when it comes to infrastructure and operation, especially in emerging markets. There are, of course, deals to be made here. Finance has to flow from brown to green. It is beginning to flow. There aren't enough deals, there aren't enough things. So the question is, how do we go about doing this? We have the opportunity in this industry to not just take advantage of the shift, but to help drive this shift with areas like developing standardization and rule sets and so on. So my final question to the panelists is, given our conversation today, what do you think is a key thing that you will be driving home? One thing to throw to the audience about what we as an industry can do or what people can do. And I'm going to start this time with Bram representing the money side. Sorry, Xavier.
Bram is my colleague.
I'm confused with his colleague, Bram Bross, who I was on a panel with 2 days ago. My apologies, Xavier.
He's shorter than me.
But he's also very good, though, Xavier.
Yeah. Thank you for starting with me. I would say, just going back to the title of the panel, so sustainable finance from small stream to mainstream. Yeah, I would say mainstream. And this is something like we can't avoid. So as just like investors in our work, but also as a citizen. So it's also to go back to the previous person on the panel was saying is like you need to convince the individuals. If you can't convince the individuals, nothing will change. So it's the behavior of everybody. So it's not just because you're an investor, you have money, you can invest somewhere. It's like you have to convince the whole community.
Ivan, then Florence.
Sean, maybe I should thank you for not having asking me anything about monetary policy. But still, this is a concern. I think we feel concerned, and that's the good news I have for you, is that central bankers, authorities feel really concerned regarding this network, this NGFS network. We started with eight jurisdictions. Today I mentioned 51 plus 12 observers, that is international organization, IMF, World Bank, BIS, looking at what we are doing. So that's the good news. You mentioned that this is a systemic issue. Systemic means that we need to work globally all together.
Florence, a quick phrase takeaway. What do we take away with us?
We don't have a planet B.
Nicely said.
Standardization.
We need more bankable projects.
Okay, there's an agenda for you folks. Go out, please, and make this mainstream on behalf of us and our children. Good luck.